Bitcoin's price is crashing right now, and almost everyone is asking the same two questions. Why did this happen? And what happens next? Most of the answers you see online, tweets, headlines, comment threads, are just guesses. They sound good, but they don't match the data. If you don't understand what actually happened and why, you're going to miss what's changing under the surface, and you won't see what comes next. So in this video, we're going to walk through why the price is really falling, who is actually selling, what broke in the market when this pressure likely ends, and what you should do, whether you're long-term or short-term. 1. Where we are right now at the time I'm recording this, Bitcoin is trading around $85,000. That's about 32% below the previous all-time high set on October 13th. So yes, this is a serious drawdown. It's also the third drop of this size in just this cycle. And we've seen dozens of similar moves in past cycles. What's different this time is the sentiment. People are treating this like proof that something is fundamentally broken. Before we jump to that conclusion, we need the right mental model. 2. The Buffett lens, voting machine versus weighing machine. When markets get emotional, I always go back to Warren Buffett. Everyone knows his line. If you're not willing to own something for 10 years, don't even think about owning it for 10 minutes. And price is what you pay, value is what you get. But the quote that matters most right now is this. In the short run, the market is a voting machine. In the long run, it is a weighing machine. Right now, the voting machine is panicking. That doesn't automatically mean the weighing machine has changed its mind. So let's stop reacting to candles and start looking at liquidity, structure, and fundamentals. 3. The force bigger than Bitcoin, liquidity. Before we talk about forced sellers, we need to talk about something bigger than Bitcoin, liquidity. When liquidity disappears, it doesn't matter how strong the fundamentals are, every risk asset gets hit. Over the last 6 to 8 weeks, we've seen exactly that. The 43-day U.S. government shutdown. The U.S. just went through the longest government shutdown in its history, 43 days. When the government shuts down, spending freezes. The Treasury General Account, the government's checking account, swells. Money is pulled out of the system every time the TGA jumps, risk assets pull back. Because liquidity is being drained from the places markets rely on for day-to-day funding. QT on top of the shutdown. At the same time, the Federal Reserve kept running quantitative tightening. QT has been pulling reserves out of the banking system. Bank reserves dropped back towards the same danger zone we hit in 2019, right before the repo market blew out. The reverse repo facility is basically empty, a sign there's no excess cash left to park. Overnight borrowing costs between banks have been creeping higher for weeks. Dealers are pulling back risk. Leverage is coming down across the board. Put this together, and you get a temporary liquidity vacuum. It hits everything: stocks, credit, crypto. But Bitcoin reacts the fastest, so you see the damage there first. If you don't see this, you end up blaming headlines instead of money flows, which are what actually move markets. 4. What really broke? The 10/10 event. Now let's talk about the catalyst almost nobody is analyzing correctly. The recent price action doesn't look like normal fear. It looks like something broke in the market structure. The day everything shifted, October 10 to 10/10. On that day, President Trump announced he would impose 100% tariffs on China. Within hours, crypto was hit by one of the largest liquidation events in its history. Almost $20 billion in leveraged positions were wiped out. In less than 24 hours, Bitcoin didn't drop 50%. Spot ETFs didn't implode. There wasn't a single macro nuke on the scale of 2020. But the forced liquidations were bigger than some of the worst candles in 2022. When liquidations reach that scale, it's not just over-levered traders that take the hit. Market makers get hurt too. These are the firms that provide liquidity, quote both sides, and stabilize volatility. When their hedges are liquidated and exchanges use ADL auto-deleverage to forcibly close positions at terrible prices, they don't just lose money, they pull back. They shrink inventories, they quote smaller sizes, they leave holes in the order books. That's exactly what began on 10/10. On Binance, we saw one of the largest forced liquidation clusters ever. Leadership admitted their ADL system malfunctioned and produced fills that made no sense. Right after, Stream Finance, a $200 million delta neutral fund, lost about $93 million and went bankrupt. A fund that was supposed to be market neutral got caught in the same ADL chain reaction. That's how you end up with a market that looks like panic, but is actually structural damage plus forced unwinds. 5. The 9:30 a.m. mystery seller. Then it got even weirder. For almost 2 weeks, someone has been selling Bitcoin every single day at 9:30 a.m. Eastern, the exact moment the US stock market opens. Same time, same pattern, same pressure. That is not retail. Retail doesn't wake up and precision dump Bitcoin at the Wall Street Open every day. This looks like a mandated seller. A fund being unwound, a market maker, de-risking position being closed because it has to be, not because someone feels like selling. The technicals confirm this. Daily MACD has printed the lowest reading in Bitcoin's history, lower than the COVID crash, lower than the FTX collapse. Yet price is only down around 33%. In a normal, healthy market, you don't see that kind of extreme technical stress for that size of move without classic panic. Here, RSI hits 21 on the daily, a level that usually only shows up in real capitulation. But the tape doesn't show wild emotional dumping. It shows steady pressure. That's the tell. This is one or more forced actors unwinding into a damaged microstructure, not millions of people suddenly giving up on Bitcoin. 6. While prices fall, fundamentals are strengthening. Now here's the crucial part. While everyone is staring at a 30 to 35% drawdown, Bitcoin's fundamentals have been moving in the opposite direction. They're getting stronger. Spot ETFs and institutional pipelines. Spot Bitcoin ETFs launched in January. They've created permanent pipelines from traditional finance, pensions, endowments, insurance companies into Bitcoin. This is slow, conservative money, the exact opposite of the leverage that blew up on 10/10. Bitcoin enters the credit system. On the credit side, JP Morgan now accepts Bitcoin as collateral for institutional loans. That's a major milestone. It means Bitcoin has crossed over from being purely a speculative asset to an asset you can borrow against. Once Wall Street accepts something as collateral, it enters the credit system, and demand becomes structural, not just narrative-driven. The FHFA, which regulates Fannie Mae and Freddie Mac, has also said that mortgage underwriters may consider Bitcoin holdings when evaluating a borrower's financial strength. For years, Bitcoin was treated as a fringe internet toy. Now it can help you qualify for a mortgage. Institutional custody and securities. Custody is fully institutional. Fidelity U.S. Bancorp, Standard Chartered Air, all running regulated Bitcoin custody operations. Coins held there tend to leave the liquid trading supply for years. On top of that, the hash rate hit a new all-time high this year. The network is more secure than ever. Miners are investing hundreds of millions into hardware and energy contracts. They're not positioning for a short-term collapse. Sovereign interest is accelerating. The US government holds over 200,000 Bitcoins through seized assets and strategic reserve discussions. Multiple states are exploring Bitcoin treasury allocations. Other countries are openly studying strategic Bitcoin reserves. Early days, yes, but the direction is very clear. Put all of this against a 35% price drop, and the picture flips. The voting machine is scared. The weighing machine hasn't even finished its calculations. 7. When does this end? Forced sellers have one defining characteristic. They run out. They don't control the price. They don't control the timing. They sell until the inventory is gone. When you see a seller dumping at the same time every day, through thin liquidity into a damaged market without reacting to price, you know the story ends when the position is empty. When that happens, the pressure often disappears instantly, and you get sharp snapbacks, like in March 2020, May 2021, after FTX, and even back in the MT Gox era. There's a second piece. Liquidity can turn quickly. The same way it's been drained over the last 6 to 8 weeks, it can come back. The government shutdown is over. The TGA is full and ready to start spending again. The Fed ends QT on December 1st. Bank reserves stabilize once that flow stops. So this ends when two things converge: seller exhaustion, liquidity returning. We ray moving towards both. 8. What should you do? What you do depends on your time horizon. For me personally, Bitcoin is a long-term asset. I don't care what it does this week, this quarter, or even this year. I bought it because I understand the network, the adoption curve, the monetary structure, and where this is going over the long arc. On that timeline, a 30 to 35% liquid-driven move doesn't change anything. If anything, it creates opportunity. But I also manage capital for people who do care about quarterly returns, drawdowns, redemption windows. So inside the Bitcoin Opportunity Fund, we hedge. We use options. We take tactical positions. We stay long but manage downside liquidity. If you have short-term obligations, bills, liabilities, investors, you can't just ride out every structural shock. You may need diversify cash and yield producing assets more. Stable cash flow exposure. There's nothing wrong with that. Just be honest about what you're optimizing for. If your long-term gives nothing fundamental has changed. If your short-term gives manage risk, hedge, diversify. The key is simple. Match your strategy to your time frame, not to the headlines. 9. How the bottom line when you strip away the noise. The liquidations, the broken microstructures, the liquidity vacuum out, you're left with the same asset, the same adoption curve, the same long-term story. This move is not the market weighing Bitcoin. It's the market voting under pressure, driven by flows, not fundamentals. The weighing machine hasn't finished its work yet. Buffett would look at this and say, if the long-term economics are getting stronger while the price is falling, you're looking at opportunity wearing a disguise. That's exactly where Bitcoin is right now. Check the link below, grab it, study it, and compare it to everything we just walked through. It will give you a lot more clarity than doom scrolling Twitter. That's what I've got for you. To your success.